Hello viewers, welcome to my channel. I am Hasham Ali Khan. So far 18 problems I have completed on depreciation. In this video, 19th problem I am going to explain in detail. See the problem number 19, but before that I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep ready the problems. Without understanding the problems, you cannot understand the solution. So always keep it ready beside you, and also always have a notebook, pen and calculator while watching the video. Whenever I say important point, immediately you should write it down. Then only you can be able to remember till the examination, and with full seriousness you should watch the video. Then only you can be able to gain a lot of knowledge from these videos. So before starting the video, take a screenshot of the solution of problem number 19, then I'll explain in detail. Now, see the 19th one. David Parnell is a trader. His financial year ends on 30th September. Every year he is closing the accounts on 30th September. He purchased following motor vehicles on credit from Peter Drury on 1st October 2004. So this David Parnell, he is a businessman. He is closing the accounts every year on 30th September. He has purchased two motor vehicles. That is motor vehicle KUA 468 costing 20,000. Another motor vehicle VWU 503 costing 16,000. Name of the motor vehicles are given. We are not concerned. We are concerned only with the amount. First motor vehicle purchased for 20,000. Second motor vehicle purchased for 16,000. These two motor vehicles were purchased on credit from the party supplier Peter Drury. David Parnell decided that depreciation should be calculated on motor vehicle owned at 30th September each year at the rate of 25% per annum using straight line method, SLM. Remember, 25% is the rate of debt on straight line method. A full year depreciation should be provided in the year of purchase, but no depreciation should be provided in the year of disposal. So one condition David Parnell has given, that when the machine is purchased, when a motor vehicle is purchased, full year depreciation should be provided in the year of purchase. We should not calculate for months. Complete year we have to provide. Similarly, when the machine or motor vehicle is sold, no depreciation should be provided in the year of sale. Now, on 1st April 2006, actually the first two motor vehicles were purchased on 1st October 2004. Now on 1st April 2006, David Parnell decided that one motor vehicle was not required and he sold vehicle VWU 503 on credit to Rumera traders at $12,500. Simply, on 1st April 2006, the second motor vehicle, that is VWU, was sold for $12,500 on credit to a customer Rumera traders. Required. Number one, name one accounting principle which is applied when non-current assets are depreciated. When non-current assets are depreciated, which accounting principle is applied? Only one it is asking, but we will give two accounting principles for your knowledge. Right? Second, explain why the accounting principle name in one is applied when providing for depreciation of non-current assets. The first question says, which accounting principle is applied while calculating depreciation? So, there are two accounting principles. The first accounting principle is accrual or matching principle. And the second accounting principle is prudence. It is asking only one. You can write only one. But for your knowledge information, I am explaining about both. So, matching principle or prudence principle. These two principles are applied when calculating depreciation. Second question, why this accounting principle is applied? What is the purpose? Now I am explaining matching principle. According to matching principle, all cost incurred during the accounting period should be matched with the revenue earned in that accounting period. So here depreciation is an expense. It is a when the non-current asset cost is spread over the life of the asset, then the part of the non-current asset should be charged with the revenue according to matching principle, to ensure that the loss on the value of the non-current asset is spread over the period in which earning revenue. The cost of the non-current asset should be spread over its life and charged against the revenue. Example, if the cost of the machine is, let it be $10,000 and the life of the machine is 10 years. So 10,000 divided by 10, 1,000 every year it will be depreciated. So $1,000 should be charged against revenue. Then only we can get the true profit. That is the reason why we apply matching principle. Prudence. According to prudence accounting principle, the profit should neither be overstated nor understated. The correct profit should be ascertained. So if we do not provide depreciation, our profit will be overstated. So in order not to overstate the profit, we have to charge depreciation, because depreciation is also one of the cost. It's a non-cash cost. If we do not provide depreciation, our profit will be overstated, and also non-current asset will also be overstated. So not to overstate the profit, not to overstate the non-current assets, we have to provide the depreciation. That is according to prudence accounting principle. That's all. The first A bit completed. Now B bit, it is asking you, write up the following accounts in David Parnell's ledger for each of the years ended 30th September 2005 and 30th September 2006. For 2 years we have to make the ledger accounts. Which are the ledger accounts? Motor vehicle account, provision for depreciation of motor vehicle account, and disposal of motor vehicle account. This disposal of motor vehicle account is required whenever the asset is sold. In our problem, one motor vehicle was sold. That's why we need disposal account, disposal of the motor vehicle account. So 3 account format you make. First account is motor vehicle account. The complete format ledger account you make: date column, details dollars, date, details dollars, debit column and credit column. Similarly, asset disposal account or motor vehicle disposal account, right? Same format. Similarly, provision for depreciation on motor vehicle account. This is the provision for depreciation. 3 accounts we have completed. Now we'll start posting the entries in the ledger accounts. First of all, the 2 motor vehicles were purchased on 1st October 2004. When motor vehicles are purchased, the entry will be motor vehicle account debit, and the supplier is Peter Drury. Peter Drury should be credited. The motor vehicle account debit side, 2004 October 1st, Peter Drury, KUA 468, VWU 503. These are the names of the vehicles. The first vehicle cost is 20,000, second vehicle cost is 16,000. The vehicles are purchased, right? Now, the first year ends on 30th September 2005. 30th September 2005, we have to provide depreciation, 25% on straight line basis. So, 20,000 is the cost. So, 25% of 20,000, it comes to 5,000. And 25% of 16,000, it comes to 4,000. That means 5,000 is the depreciation on first vehicle and 4,000 is the depreciation on the second vehicle. Total depreciation is 9,000. 9,000 is the depreciation. So entry for depreciation, income statement debit, provision for depreciation credit. Income statement debit, provision for depreciation credit. So here credit side, income statement 2005 September 30. Income statement KUA 5,000. How we got 5,000? 25% of 20,000. and 25% of 16,000, you'll get 4,000. So 5,000 plus 4,000, 9,000 is the depreciation. Now we close the first year. The first year will be closed on 30th September 2005. So here 9,000 is the total. Here also 9,000 carried down. This is the balancing figure. 9,000 is the closing balance of provision. 2005 September 30th. Now bring it down, brought down balance. 1st October 2005. New second year will start. 1st October 2005 balance brought down 9,000. Here also we close the account of motor vehicle. Here the total is 36,000. Take 36,000 on credit side. This is the balancing figure. Balance carried down 36,000. Now carried down is taken on the credit side, so brought down on the debit side. Balance brought down 36,000 1st October 2005. Now we are in the second year. The second year will end on 30th September 2006. But before that, before 30th September 2006, one motor vehicle was sold. It is given that where it is sold on 1st April 2006. Actually year end on 30th September. But on 1st April 2006, David Parnell decided that one motor vehicle was not required and he sold the motor vehicle to Rumera Traders on 12,500. So what is the date? 1st April 2006. Now on 1st April 2006, we have to pass the entries on sale of motor vehicle. First, the transfer of motor vehicle to new account called asset disposal account. The entry will be asset disposal account debit, motor vehicle credit. Which motor vehicle? Second motor vehicle, 16,000. So what is the entry? Asset disposal debit, motor vehicle credit. So asset disposal debit side, motor vehicle account 16,000 on 1st April 2006. And motor vehicle account should be credited. So motor vehicle account credit side, asset disposal account 16,000. First entry we have posted. The second entry, depreciation provided on that second motor vehicle should be transferred to asset disposal account. How much is the depreciation provided on second motor vehicle? 4,000. 25% of 16,000. 4,000 was the depreciation. That will be transferred. Entry will be provision for depreciation to asset disposal account. And a provision for depreciation on motor vehicle debit, asset disposal credit. So here debit side I am writing asset disposal account 4,000. So provision is debited, asset disposal is credited, provision for depreciation on motor vehicle 4,000. So two entries posted. Now third entry will be sale proceed. We are not selling on cash, we are selling on credit. To whom we are selling on credit? Rumera Traders. So entry will be Rumera Traders account debit, asset disposal credit. Rumera Traders debit, asset disposal credit. So asset disposal account credit side, Rumera Traders. At what price it is sold? It is sold for 12,500. 12,500 it is sold. Now take the balance. The balance is the profit or loss. So simply you see, if credit side is more, the balancing figure you will get on debit side, that is the profit, and profit should be transferred to income statement. So here credit side 4,000 plus 12,500, 16,500. So take same 16,500. From 16,500 deduct 16,000. So how much is the balance? 500. This will be transferred to income statement. This is the profit on sale of motor vehicle. $500 balancing figure. So always asset disposal account will get closed. The balance will be profit or loss. If credit side is more, there is a profit. If debit side is more, there is a loss. That point you have to remember. So now we'll close the account of motor vehicle. Motor vehicle debit side we have 36,000. From 36,000, one asset was sold 16,000. Now balancing figure, this balancing figure is 20,000. Balance carried down 30th September 2006. Now brought down. Next year will start from 1st October 2006. 1st October 2000. Balance brought down 20,000. This is carried down, this is brought down. So this account also we have completed. Now lastly, provision for depreciation. Now provision for depreciation, you can see current year depreciation we have to provide on the first motor vehicle. Straight line method. The first motor vehicle 20,000. 25% of 20,000 is 5,000. So 5,000 is the depreciation for the current year on first motor vehicle. Income statement. 25% of 20,000. 25% of 20,000. It comes to 5,000. So 5,000 we have taken. Now 9,000 plus 5,000, 14,000. Take same 14,000. 14,000 minus 4,000. So 10,000 is the balancing figure. So 10,000 is the balancing figure. Right? This is at the end of the year 30th September. Now next year will begin from 1st October 2006. 2006 October 1st, balance brought down 10,000. That's it. So motor vehicle account will show a balance of 20,000. First motor vehicle. Second motor vehicle sold. And provision for depreciation, the beginning opening balance will be $10,000. That's it. So this is the end of problem number 19.